Hello everybody, welcome to Homeowner Help Radio. I'm your host Julius Nyanda. This is our first video blog here on a Sunday. A lot of people out there watching football. I'm into football as well, but I figured I would take this time to really knock out the first blog entry when I was sure that nobody would be in the office because I didn't want to embarrass myself. So today's information or today's video blog is really about dealing with issues relating to income. Because a lot of people give me questions about income, especially self-employed people, and I've seen a couple of files over the last few months that have really gotten beaten up because employees take employee expenses. So this whole series that I'll be coming out with over the next couple of weeks is really going to be devoted to things that I see on loan applications by first-time home buyers or people that are going back to try to refinance, and it's very different from how it was, 2 or 3 years ago. So we all have to adjust to the new regulations, the new guidelines that have come out in the wake of this major housing collapse. So I'm hoping that you guys will pay attention to the next few PowerPoint slides, get some information, give us some feedback at helpradio1.com. Click on the button, let us know what you think, let us know about topics that you'd like to hear about. Today's topic is on 2106 expenses. And I say this specifically for people that go through and apply for a loan, turn in all their income documentation, and then they come up wondering why they got turned down for the loan. Well, originally, you gave the information, you told the loan officer what you made, you turned in your documentation. Maybe you're working with a loan officer that isn't quite sure how to calculate income. That file continues to go on through the process, but then when an underwriter gets it, their job is to make sure they know what your qualifying income is. And sometimes some of the deductions that you take on your tax return, which is pretty fitting because we're going into tax season, can affect the income that's used to qualify you for a new mortgage loan. So pay attention to the next couple of slides. I'll be back at you on the other side.
So let's jump into these slides. Now this slide presentation is based on what I call the Silent Deal Killer series. The Silent Deal Killer series just has to do with people that fall in love with property, start the loan process, only to find out when they get to the closing table that they never qualified for the loan in the first place. I don't want to see that happen to any of you guys, so these presentations and the future presentations that I have within this series are going to be devoted to helping you plan ahead and be better prepared. So plan ahead is the theme. You want to make sure as much as possible, plan ahead when you're borrowing money. Two people that I can say that you need to meet with is one, obviously your loan officer, and two, your tax advisor. This is not tax advice that I'm giving on these slides. These are simply the forms that you fill out that are usually done with your tax preparer or tax advisor or CPA, and I'm trying to help you realize what the connection is between those forms and how you qualify for the loan. The things we're going to look at are your down payment, credit scores, and we want to get an idea for what your income situation is. Now, the two things we don't want are surprises at the application, because sometimes you apply or you go through and you don't know these things. Worse yet is when you get the surprise at the closing table. Income in a loan application is pretty much looked at based on the loan application that you fill out, the pay stubs you turn in, the tax returns, and W-2s and or 1099s. Some of you that are strictly employees, you only have W-2s to turn in. Others that are self-employed, you also get 1099s. Now, I want to pause for a moment and point out this. It used to be that when you were an employee, you didn't have to worry about turning your tax returns because all we needed was a W-2 and pay stubs. Now that the industry's changed and in the wake of the foreclosure crisis, every lender is requiring full tax returns. And full tax returns means that we're looking at other expenses that otherwise would have gotten swept under the rug, and now that's part of your qualification. So just keep that in mind. Some of you are like, oh, I don't have to do this because I applied, for a loan 2 years ago. I applied for a loan a year ago. All that's changed now. The industry is constantly making it harder to borrow money. Back to the presentation. We review what you've turned in and we verify the information with the IRS. So we don't take your word for it. Even though you've turned in documentation, we order that same documentation from the IRS. This is also a problem for people that try to amend their tax return because they turn in an amended tax return to try to make a change. Hey, we get that original one and the amended one, so keep that in mind. So our job as a lender is to make sure we find out what your qualifying income is. Basically, what the investor who's going to buy that mortgage from us is making sure is that we have not overstated your income. This is very different from when you apply for down payment assistance. They want to make sure that you haven't understated your income. So when you apply for a loan, we're probably going to give you the least credit for income possible, when you apply for down payment assistance, they're going to give you the maximum amount of down payment possible because they want to make sure they don't give money to a family that shouldn't have it. We want to make sure we don't give money to a family that can't pay us back. 2106 expenses. So on your federal tax return, which is your 1040, some of you have itemized tax deductions. This is very different from standard deductions. Standard deductions are pretty much going to be what you see the IRS gives for that year as far as a schedule, depending on your filing status. If you're single, if you're married filing jointly, married filing separate, all those different filing status have various standardized deductions. If you feel like you can get more, then some people itemize the deductions. Deductions, whether they're standardized or itemized, are expenses that lower your taxable income. Basically lowers the amount of taxes you pay. Employees, people that are W-2, can itemize their unreimbursed business expenses using Form 2106. Auto mileage is the most common deduction I've seen. So when you get your tax return, you turn that into us, the very first thing I look at is going to be your Schedule A to see how you've itemized deductions, if you do use a Schedule A. Some of you don't have a Schedule A because you file a 1040 easy form and take the standard deduction. So this is not really for you. These are for the people that file Schedule A tax deductions. If you file a Schedule A, you'll see this type of schedule in your tax return. So look through it, flip through it right now, take a second, see if you filed a Schedule A, and follow along because you can try to see if your documentation matches up what I got on the screen. 2106 expenses are the next section that I'm looking at on the Schedule A. So I pull out your 1040, find out if you have a Schedule A, and I immediately scroll down to line 21 to see the unreimbursed employee expenses. You can see there job travel, union dues, etc. What I'm looking for then is to flip over to your unreimbursed employee expenses to see what kind of expenses you took. The number one, line one, vehicle expenses, like I said, is the most common one I see. Usually when you write off a bunch of mileage, it's a great tax deduction for you, but just keep in mind that your qualifying income will be affected by how you took that deduction. Vehicle expense here, you can see how it's done. You enter the date the vehicle was placed in service, total miles, you back out what you use for commuting, and you come up with a final number. And that's usually how you get your deduction. So look at that vehicle expense section of your 2106 form. See if you got this on your screen, like what I've got on the screen. So how 2106 expenses hurt you? This is really a deal killer for a lot of people. And it's important for you to understand this. So if you claim 2106 expenses on your tax returns, that amount will be subtracted from your qualifying income. So you make $60,000 gross income, that's $5,000 a month. You want to apply for a loan? Great. We go through the process. We use $5,000 a month to qualify you. We put that in the system. We're running our automated systems. Everything's checks out. All of a sudden, we look at the 1040 tax return and we see that you took $14,000 in 2106 expenses. Now what happens is that $60,000 in gross qualifying income now becomes $46,000 in qualifying income, which is $3,833.33 a month. Very different from $5,000. So what does that mean? That means that if you qualified for a loan and we backed out $14,000 in 2106 expenses from $60,000 in income, we could basically have to qualify you for $75,000 to $80,000 lower of a loan amount. So that's why it's a deal killer, because some of you don't have $75,000 or $80,000 laying around to throw on top of your existing down payment. So that's how 2106 expenses can hurt you.
So I hope you got some great information about 2106 expenses and how they can be deal killers. I know a lot of times when you're going through and applying for a loan, it's moving so fast that you're not really aware of some of the documentation that you're turning in. But I want to make sure I give you sort of some insight into how we look at your loan file, so it's not such a surprise when you get to the process. Don't fall in love with that house before you've planned ahead. That's probably the key message that I can put out there. 2106 expenses hurt a lot of people. And I want to reiterate, people that applied for a loan a year ago, 2 years ago, 3 years ago, and you're like, oh, no, I didn't have to turn in documentation the first time. Great. Now, it's a completely different process. The loan business is responding to a foreclosure crisis, and the way they respond is tightening up the guidelines, and that means that every document and everything that you turn in has to be verified, and that verification process can create issues like with these deductions that you take as an employee. If you have any questions about the documents or anything that I brought up, please email me at julius@helpradio1.com. That's JULIUS@helpradio1.com. Also, all the forms that I've talked about and I mentioned in the PowerPoint are going to be beneath this video. You'll see them down there. Check them out. I got the 1040, the Schedule A, the 2106 form. Make sure you get yourself familiar with these forms because now that it's tax season, you're probably going to be filing soon, especially you guys that need that tax refund right away. All right? So thank you for sitting here with me for a few minutes here at Help Radio or Help Radio. Hope Radio might be kind of cool too. But it's helpradio1.com. Make sure you check in every week to see what we posted. Jason's probably going to get with us a couple of days to do a week in a review, but I'll always be putting these little video blogs out there to help you get some more information about how to apply for a loan. All right? You guys take care. Have yourself a great evening or great afternoon or great morning, depending on when I caught you.